Hello, I'm Anthony Saglin-Benny, Chief Market Strategist at Ameriprise Financial. Now that we've closed the chapter on 2024, it's time to look ahead to 2025. To help you make sense of what could be in store for the new year, I have a great panel of experts with me to share their insights and predictions. First, I'd like to introduce Russell Price, Chief Economist at Ameriprise, and Brian Erickson, Fixed Income Strategist at Ameriprise. Thank you both for joining me today. Russ, I'd like to start with you. We enter 2025 with an overall favorable economic backdrop. What's your forecast for economic growth prospects this year? And will consumers begin to feel better about the economic picture in 2025?
Well, Anthony, for the last 2 years, maybe going on 3 years now, the U.S. economy has maintained a fairly steady cruising speed that's been generally better than forecasts had been expecting. As we enter 2025, we again are looking for a deceleration in the pace of economic growth, but modestly so. We still expect a relatively solid pace overall. We're forecasting the U.S. economy to grow at a real inflation-adjusted rate of just over 2% versus what looks likely to be a rate of about 2.8% for 2024. That 2024 rate being generally in line with 2023. There are two key divergent issues that we consider when looking at the year ahead. First, the economy's fundamentals are in good shape in our view, thus supporting the overall growth narrative, maybe even with some room for upside. That being, consumers are in good financial shape, as is corporate America. But second, what stands as a considerable uncertainty is the potential for tariff actions or fiscal policy changes that could implement the pace of economic activity and inflation. If tariffs are widely implemented, we believe it would result in some upside for inflation of potentially about 0.5%. The purchasing power lost to inflation would thus likely result in some negative influence on economic growth, but still with the pace remaining solidly positive in our view. Finally, consumer sentiment should also continue to see support from a relatively sound job market. The U.S. Unemployment rate ended 2024 in the low 4% range, a level we believe is maintainable through 2025. So Anthony, turning back to the market side of the equation, 2024 was overall a productive year for stocks. So I'm wondering, do we think that momentum can continue in 2025? What factors might hurt or help stock prices next year or this year? And might we be due for a little bit of market volatility, which we really haven't seen too much of lately?
Yeah. Thanks, Russ. As you mentioned, 2024 was a really good year for U.S. stocks. The S&P 500 index logged its second consecutive year of 20% plus returns. That's a first since 1997 and 1998. And what turned out to be a pretty solid economic backdrop, like you talked about. We had a very solid profit backdrop last year and obviously strong tailwinds from artificial intelligence. At the start of this year, those conditions, I think, really remain in place. But we could also see profit growth expand into areas outside of technology in 2025. All 11 S&P 500 sectors are projected to grow earnings this year, with big tech, projected to do most of the heavy lifting, just to a lesser extent than last year. And notably, prospects for slightly lower taxes, less regulation, a business-friendly environment in Washington, these are all factors that could add modest support for stock prices this year. But as you know, we live in an increasingly volatile global landscape, and there's the potential for escalating tariff threats, as you mentioned. Asset valuations are already elevated, and there's a risk that monetary or fiscal policies come up short of expectations. So to answer your question directly, Russ, stable economic conditions, growing profits, the potential for lower interest rates, and a pro-growth focus in Washington, these are factors that could lead stock prices modestly higher, but likely with more volatility than investors have experienced over the last year or so. And that's because stock valuations are elevated, particularly across technology, and growth expectations for this year are already high. And so it leaves less room for upside surprises, particularly if tariffs and geopolitical frictions create risk to the downside. One of these concepts we've talked about is guarded optimism for 2025. So focusing on well-established diversification strategies, concentrating on high-quality U.S. investments, incorporating strategies that focus on yield and security selection, and industries that can benefit from stable growth, secular themes, less regulation. This is how investors can approach the new year and our outlook for 2025. And to answer your question around volatility, I think it starts with rebalancing your portfolio. Work with your financial advisor, to talk about where your strategic targets lie versus your portfolio. We've had a couple really strong years in the stock market. At the same time, returns haven't been as robust for fixed income. So make sure that your portfolio is aligned with your strategic target, and have conversations with your financial advisor, proactive conversations about what would you do if volatility showed up. What if your portfolio declined 5 or 10 or 15%? Would you be comfortable staying the course? Is that an opportunity to invest more, or would such declines create stress? Having these conversations proactively before volatility kicks in is, I think, a smart strategy to start the year for 2025. And so, Brian, I want to bring you into the conversation and kind of get your perspective on the bond market. What are some of the big themes that could influence the performance of fixed income investments in 2025? And specifically, what effect might the projected pace of interest rate cuts have on both the bond market and cash investments?
Thanks, Anthony. I think there are four key takeaways for 2025 investing in fixed income markets. The first is that yields remain attractive. At the end of last year, high quality fixed income investments, represented by the Bloomberg US Aggregate Index, yielded 4.91%. That's nearly 5%. And over the course of last year, that yield rose 0.25%. As you recall, when fixed income yields rise, that means prices soften a little bit. So what we're seeing is a little bit lower prices today on fixed income than we did at the beginning of last year, which is difficult to say about many investment sectors that are out there in the marketplace. The second key point is related to the Fed. The Fed cut rates by a full percentage point in 2024. This year, we anticipate they continue to cut rates, policy rates. We think it's roughly a half a percentage point this year. And for cash investment yields, that suggests that we saw yields fall last year. We think that they're going to continue lower for cash investments in 2025, suggesting that it's a great time to think about terming that out, investing that in fixed income. Short-term investments are about the same yield as cash, and long-term investments even offer a greater yield than cash today. So great time to invest that excess cash. The third point is that we expect there's going to be a little bit more volatility in treasury markets. Globally, there's been more focus on populist political elections last year, and there's a focus on some of the fiscal discipline that's really kind of become an issue here globally. In the U.S., we see that Washington returns to governing with issues like trade, and taxation, and potentially government spending on the blotter. Around that, we think that there could be some additional volatility in treasury markets, which just suggests that you could reduce some of the volatility from treasuries specifically by diversifying across high quality assets like government bonds, agency bonds, investment grade corporate bonds, as well as munis where appropriate. That broadens out some of that exposure and creates a better experience for investors looking at that. When you look at the fourth thing that we're talking about this year, it's based on the economy. The economy's strong, corporate cash flows are strong, corporate profits are strong, and the labor market's healthy. Those are key ingredients to having success with investing in corporate bonds as well. And we see investing in investment grade and high yield corporates as a very attractive way of gaining exposure in fixed income portfolios here at the start of 2025.
Really insightful perspective and some great takeaways for investors as we start 2025. With that, thank you to my colleagues, Russ and Brian, for joining this conversation. And thank you to our clients and other viewers for watching. If you have questions about current market conditions or would like to receive additional timely insights from the Ameriprise Investment Research Group, please contact your Ameriprise Financial advisor. Thank you.